So here's where we get into another really short section, folks. This has not got a whole lot to it. Federal income taxation and real property ownership. So this is where we start talking about the benefits of owning property and some certain tax laws that you have to be aware of, things of that nature. And I'm going to talk about, this kind of in a matter-of-fact way because it's not super formal. One second. So let's talk about the benefits of owning a home first, okay? When you own a house, there are certain benefits to it. The biggest one being tax deductible expenses. There are certain costs that you can deduct on your taxes. Now, if you're not familiar with tax deductions, it's not a credit. But folks, if we said that you made $100,000 a year, you could, as a taxpayer, elect to take what's called a standard deduction, or you could itemize your deductions. And so a deduction is something that allows you to reduce your taxable liability. So if you, for instance, had $30,000 in allowable tax deductions, what that's doing is stating that you really owe the government taxes as if you had made $70,000, not as if you had made $100,000. That is what a tax deduction is. And there are certain things dealing with real property ownership that is tax deductible. Of course, the mortgage interest on first and second homes, because remember we said in that amortization discussion that a whole lot was going towards interest initially. And then, of course, over time, it kind of shifts. Discount points in the year that you bought them would be tax deductible. Of course, any prepayment penalties, if you had to pay them, would be tax deductible. Loan origination fees in the year that you paid them would be tax deductions. Mortgage insurance premiums, so long as you're paying them, would be tax deductible. And last but definitely not least, real property taxes for the year that they're paid. Because if you're already paying the taxes to somebody, they can't really expect you to pay taxes on that income again. So all of these are potentially tax deductible to reduce your taxable liability if you itemize your deductions. Pretty useful. The other big thing that comes into play dealing with taxes, and I mentioned this briefly in the closing a real estate transaction section. Folks, when you own a house, it's considered an investment. If you sell that investment and you make money, that is called a capital gain. And so I told you that one of the big jobs of the settlement agent is to submit to the IRS the document stating how much the seller made. And I told you that they may or may not have to pay taxes on that depending on if they're exempt. And so there's this really cool tax exemption, folks. It's called the capital gains tax exemption. And so what it states is if you own a home as your primary residence for 2 out of the last 5 years, they do not have to be consecutive years, 2 out of the last 5 years. If you sell that home, you are exempt from paying taxes up to $250,000 as an individual and up to $500,000 as a married couple in capital gains. And so there is a formula for calculating capital gains, but it's a very cool kind of tax law, right? Because folks, imagine that you buy a house for $200,000. And then you turn around 3 years later, and of course this is an extreme example, but we had this kind of happening in COVID time. If you turn around 3 years later and sold it for $400,000, this is an oversimplification, but let's say that you had capital gains of $200,000. That's $200,000 in income you made. Because you lived there for 3 years, even as an individual, you wouldn't pay a dime in taxes on that. None. Zero. Zit. Nada. Which is pretty fantastic. Now, the formula for calculating the capital gains is a little more complex than that. We're going to get into it in just a second. But before we do, understand that just like any investment, the government groups it into short-term gains and long-term gains. And so a short-term gain is something you held for less than 12 months. A long-term gain is something you held for longer than 12 months. And of course, the long-term gains are taxed at a lower tax rate than the short-term gains. But it is a very cool tax law. Folks, there are some people who take advantage of this where they buy a property that needs work, they move into it, they renovate it, they live there for 2 years, they sell it, they take all that money, they wash, rinse, repeat. I couldn't do this because I hate moving, but it's a very cool strategy if you don't mind moving. Bree says, is the 2 out of 5 years? Yeah, that's a federal requirement. It's an IRS thing, not the North Carolina Department of Revenue. So when we're calculating these gains, there's a couple pieces of terminology that come into play. And now I've been told that you're not going to have to do the math on this anymore. So I'm going to show you how to do it just in case, but allegedly you're not going to do the math. But you may need to know the terminology though. And so folks, can we all agree that if you buy a house for $200,000, because of certain closing costs, it's probably going to cost you more than $2,000, right? Or $200,000. And so that's what we've got as a cost basis. Okay, that's your starting point. The cost basis is what you bought the house for plus what they would call allowable closing cost. So if your allowable closing costs were $3,000, what your cost basis really is would be $203 in this example. Now, if you've done major renovations to the property or what we call capital improvements, that's also part of owning the house. Things like replacing the roof, replacing the HVAC, big expenditures. You could also add that in there. And what that does is that reduces the potential for having any taxable liabilities. So if you had a roof that you put on for $30,000 in this scenario, you would utilize what's called your adjusted basis, which is where you take your cost basis and add in your capital improvements. In this case, making your adjusted basis $233,000. And you can see the reason you would do this is because the bigger the number is that where you started, the less likely you are to have to pay taxes. Because really and truthfully, the government can't charge you taxes on money you didn't actually make if you had to invest a lot in owning this property. So, talking about capital gains here in this income taxation section and just the different tax conversations we could be potentially having with these real estate. When we're talking about calculating capital gains, there is the cost basis, which is what you bought the property for, plus what we call allowable closing costs. Not all closing costs are allowable, only some are. And then if you've done any capital improvements, that's where we said you can add that back in because you've invested that money into the property. You can't say that when you sell it, you've made X amount if you actually had to invest some in it. So when you add the cost of capital improvements in, you end up with a number called the adjusted basis. In this example that I'm kind of plugging away at here, that would be $233,000. And so then you've got to find, when you sell it, what we call your amount realized. So if you sell a property, for example, for $500,000, yet again, when you sell a property, you've got closing costs, you've got commissions, you've got attorney's fees, you've got things of that nature. So the amount realized is what you sell it for minus your allowable closing costs. And so, for example, this would be, let's just say if you had allowable closing costs of $30,000. And so your amount realized in this instance would be $470,000. And so your capital gain is where you take your amount realized, and these fictitious numbers I came up with, of $470,000. And then you subtract out your adjusted basis. And on the previous screen, that was $233,000. And that gives you what your actual capital gain is, or capital loss if you lost money, but hopefully you didn't. So $470,000 minus your $233,000 would be $237,000. Now, do you see why this is a benefit, folks? If an individual had lived here over 2 years and sold this property, using these calculations, their amount realized was $237,000, which means they're exempt from paying a dime of taxes. If we had just used the numbers $500,000 and $200,000, which was the original purchase price, that would say they'd be responsible for paying taxes on $50,000. So it wouldn't be fair to charge you taxes on money that you didn't actually make. So that is how we calculate those. And as I said, you know, they said that you don't have to do the math anymore, but you will potentially need to know those amount realized terms, cost basis, adjusted basis, all that fun-filled jazz. So here's just another example, kind of like what I just did here. Purchase price and original closing cost, $98,550. Cost basis, $98,550. Folks, I actually had a transaction like this a couple years back where my clients bought a house for like $1.2 million, and the original owner had been there for over 30 years and bought it for like $150,000. So they had quite a bit of money made on that property. And would have ended up owing some capital gains on it, obviously, but this is just an example. And so if this was a married couple filing $500,000 exemption, their capital gains are $725,000, they would still be paying taxes on everything in excess of their $500,000 exemption. But you don't have to do the math. You don't have to worry about the tax rates or anything like that. Just kind of understanding how this works in general is going to be sufficient for the sake of the test. Another tax discussion, and yet again, not going to be crazy testable, but you definitely need to know what it is on the test. A 1031 exchange is something that you could possibly see. Sometimes called a like-kind exchange, sometimes called a tax-deferred exchange. And so that tax benefit that I was just talking to you about was a primary residence, right? The like-kind exchange is utilized for investment properties. So if you own an investment property, you can, if you follow certain rules under the tax code 1031, you could potentially sell the property and reinvest all the profits into another property without having to pay taxes, albeit temporarily. It's a tax deferred exchange, not a tax exempt exchange. So you're basically kicking the can down the road. And so it's also called a like kind exchange because you would take the profits from selling one property and you have to reinvest them into a more expensive like-kind property, right? Residential units into more residential units, agricultural into more agricultural, medical buildings into more medical. And as long as you follow certain rules and meet certain criteria, you could reinvest all your profits without having to pay taxes at the time you sell it. But they're pretty complex. The rest of these you don't really necessarily need to know for tax purposes. It's just that when we're dealing with for the installment land contract, the only special thing about that is the buyer, remember we said, holds equitable title even though they don't legally own it. So they would be the ones responsible for paying the taxes and as such could potentially deduct the tax bill that they're paying for that installment land contract. The rest of it's not going to show up on the test. So let me ask you another question here. How do you determine capital gains amount? And I will accept a couple answers here. Yep, there you go. Amount realized minus adjusted basis. And of course, if there's no capital improvements done, it would just be amount realized minus cost basis. Obviously, adjusted is if there's any capital improvements, which may or may not be the case. I asked you this one last night. Let's see if you remember this. What was the formula for calculating percent of profit? Yeah, I mean, it arguably could be the same thing. Profit divided by your original investment. What you actually made divided by your original investment. Okay, what you actually profited. There you go.